It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Adriel with David Ingles.
Good morning. We're counting down to the open markets in Greater China. Let's get to your top stories today. The Japanese yen rallying against the dollar in a fresh sign of government support. Both Tokyo and Washington earlier confirmed their first joint intervention in 15 years.
Asian tech stocks drop following the launch of DeepSeek's new model, the latest threat to the AI trade that's been a boon to the region's chip makers. Oil prices fall as the U.S. and Iran plan a return to the negotiating table.
We'll watch China's AI model makers at the open today with data showing DeepSeek's latest release competing with rivals at a fraction of the cost.
And we'll hear from Hang Lung Properties Chair Adriel after the company reported a steep drop in first half profits. That exclusive conversation coming up. Dave, I have to say, they finally did it. They finally managed to bring dollar-yen below the 157 handle. That's, of course, the big thing that we're watching, aside from me being in Hong Kong this week.
Well, yeah, I was going to lead with the latter, but I think that's fairly obvious at this point in time. Yeah, so we brought in some reinforcements, given, of course, how big the market moves are today. And I think there have been fresh signs in the last hour or so that perhaps they were... No confirmation yet. They were in the market yet again. We are now trading at 155 on dollar yen. It was just very recently we were trading at about 160, 164, 165. But yes, it is certainly the market story we're tracking today very, very closely.
Yeah, and the amount of money they spend just to intervene, right? And also the level of cooperation between the U.S. and Japan. You know, I think that notepad scribble from Scott Besson was something that caught everybody's attention. But aside from that, also the tech developments, the headway that China is making.
Well, I think you're right, because the DeepSeek conversation is playing out across markets, including what we'll see, of course, when we look at the open today. On top of that, you also have the stronger yen component, which is, further headwind for markets right now. So we'll get to all of that in a moment, the details of which. But yeah, to the point Adriel was just making here, dollar yen coming up on your screens, a 4-day look in case you took a 4-day holiday. This is how quickly the yen conversation has changed. So we've rewound the clock on the yen about 3 months, and as far as absolute levels are concerned, it could not come at a worse time for yen bears, looking at how short the markets were going into last week and the initial moves there. We'll have a look at that. The oil price, speaking of rewind, we rewound the clock here about 3 weeks on Brent prices. 2-day look, big gap lower today. As you can see on your screens, we're back in the low 80s, and as far as energy prices are concerned. Right, so what is the equity market component of all this? Nikkei is off quite substantially. The Taiwanese market is coming online. We just showed you, of course, what TSMC was doing. We're just off about a third of 1%, although we are getting a backstop as far as U.S. futures are concerned. So we'll see what the rest of the session looks like and the momentum as we go into the thick of Monday. The market in focus, of course, Kospi, Kosdaq. You have the two big stocks coming up on your screens. Historic reversal higher on Friday. We're a little bit lower today, a little relative to what we've seen, of course, in the context of South Korea. And A50 futures are coming online. Not to be ignored, and something we'll talk about later on as well, were some comments coming through out of the Premier vowing more forceful measures to prop up demand. And we'll see how that plays out. In fact, right now, your 10-year yield is now on the verge of 1.7%.
Yep. So first to our top story, right? You just talked about how dollar yen's below 156.
Yep.
That's a level we've been watching. Of course, this is coming after Japan confirmed its first joint intervention with the U.S. in currency markets in 15 years. And this is following the yen last week sliding to a 40-year low. Of course, we had the U.S. president also weighing in, saying the move is a signal of friendship with Tokyo.
We have a good relationship with Japan. We're very strong, very, very strong financially. They have a weakening yen, and they wanted a little bit of help, and we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor.
Mr. President,
they were not good.
What is the U.S. getting out of that arrangement?
Financial benefit. Financial benefit. And it's also good for the world economy.
For more, we're joined by Bloomberg M Live's macro strategist, Andre De Silva. Andre, great to have you. So this is a really rare move. We haven't seen something like this in, 15 years? Talk to us about the significance, and are we expecting more of it?
Sure. Well, first of all, it kept us busy over the weekend. Nice present for Friday evening. But for this morning, yes, we've got probably another round of intervention. But let's put it in context. It's not necessarily unsurprising, at least today, there's another round of intervention. Why? Because under the IMF rules, there's a 3-day accounting rule suggested to maintain free floating label that needs to be within 3 days. So no surprise on that. The scale we don't know as yet, but at least on Friday, it was around $53 billion, which is quite decisive. But the most important thing is obviously joint intervention, as you say. Now, I used to say that in terms of intervention, if it's unilateral, it wouldn't work, it wouldn't be effective, but bilateral with the US, and the market has to take note. And if you look at implied volatility in FX, it's very expensive now to go short the market, so this is going to last for quite a bit.
How does this change, the carry trade? Yen as a funding currency. Do we need to look elsewhere because they've intervened so forcefully right now?
It's a good question. There was already some signs of that shifting anyway, looking at euro, looking at Swissy, etc. So it was not a short-term phenomenon. But this does accelerate that process, yes. But I think one main theme is still monetary policy. FX intervention masks the problem, and despite they had the opportunity last week to surprise the market and raise rates, they didn't. Next opportunity is in September. We already heard today the Vice Finance Minister stating they'll also look at monetary policy, but they need to deliver that to have more punch to the bowl.
And fiscal policy worries, right? I mean, that's also part of what's behind the worries, the yield gap that we're seeing. What are you watching out for next?
It's true, but to me that's more about the long end of the curve. I think it's the short end, and when you've got the Fed versus the BOJ, that's the fight that's battling out at the moment, with BOJ being behind the curve. So to me it's about monetary policy, and BOJ needs to raise rates. The market's already shifting a little bit, so there's a 40% chance that they'll do in September, but it's not fully priced in until the end of the year. That is the main issue.
We're showing a year-to-date on dollar-yen. They obviously moved in April. Fairly sizable move we're seeing today. Will this work? Is there any indication that we won't get back to 160? How are you looking at that short term now?
Well, so without being too precise in terms of levels, I would say the cap, I think that's already in place.
That's in.
So that's 164-ish. But in terms of how far and how sustainable this move will go, it depends on, as I said, more the interest rate policy framework than just intervention. But in terms of depreciation, I think that's off the agenda for now.
Andre, fantastic. Thank you so much. Andre De Silva, our macro strategist from MLive team there. The other top story we're tracking is in tech and AI releases out of China over the weekend here, several in fact here. It includes this updated model coming through out of DeepSeek, the V4 Flash, and the latest iteration of that. Our China correspondent, Min Min Lo, is here with us to talk us through. Everyone looked at the performance of this upgraded model. What do we know?
Yeah, the performance is good, so it has edged out the likes of Alibaba's Q1, the likes of Minimax. It is still trailing behind the Kimi K3, though, which is still seen as the market leader when it comes to AI models in China. But where DeepSeek is unbeatable is the pricing, because DeepSeek has now cut prices even further when it comes to its tokens, both the input and output tokens, as much as a 50% price cut. And already before that price cut, it's already the cheapest AI model out there. Plus, the Flash, of course, is a more efficient, smaller scale model. This could increase market adoption and even make it more feasible for perhaps medium-sized companies to host the platform themselves instead of renting from these hyperscalers. So certainly something to watch, and it's certainly also escalating the price war that we're seeing in China.
And with the competition, we're also seeing, as Dave was just alluding to, some of these other new image generation, video generation models being released.
That's right. These model releases are coming fast and furious. So we have Minimax, we have ByteDance, both of them releasing upgraded models as well. ByteDance's C-Dance is very well known in China. In fact, we can show you a sample of a video that is generated by AI there. But Minimax is ranking #1 now on artificial analysis when it comes to editing capabilities. It also ranks in the top 3 when it comes to text to video as well as image to video. And some analysts are saying that Minimax is still one of the best players out there. If you're looking at cost efficiency as well, it's still half the price of some of its peers for very high-res 2K sort of videos. So again, monetization is still a question mark there.
What do we know about this moonshot using some of the good stuff from NVIDIA via the framework with Alibaba?
Yes, this is a scoop by a couple of our Bloomberg colleagues, and we understand from sources that Moonshot has access to some 20,000 chips in a compute agreement with Alibaba. And we understand these are the H200 chips. That's what sources are telling us. But Alibaba, while they have not denied that they supplied 20,000 chips worth of NVIDIA's compute, they have denied that they were the H200. So we asked, and they didn't really say which chips they were supplying, but of course the H200s are approved for sale to China, right, under this revenue sharing agreement between the Trump administration and NVIDIA. And at the same time, a White House official has already accused Moonshot AI of illegally accessing NVIDIA servers in Thailand. But for now, actually, U.S. rules generally allow Chinese firms to rent these servers outside of China. What they can't do is to own the servers and own the chips directly. So question is whether the U.S. will tighten that loophole after, Kimi has managed to close the gap.
Still a certain level of access. Min, thank you so much. Much appreciated. Bloomberg's China correspondent Min Low. And of course, coming up on the China show, we'll be speaking with artificial analysis CEO Micah Hill-Smith on the AI race between the U.S. and China and which models are leading the AI pack.
Yep, it's their data and it's their spectrum. The markets have been obsessing over the last couple of months or so. Right, really on that note, tech shares are trading in the new week here fairly off a volatile alert start, of course, given, of course, everything we just talked about there. Plus, of course, you have this earnings season in Japan to contend with. Let's bring in Anthony, of course, to take us through what he's watching at this point in time.
Yeah, so how this plays out, right, this innovation and the pace of innovation from China, how it plays out in the AI dispersion trade is going to be very, very important. So you saw that even in the US session, we had stuff like Micron, NX semiconductor trade pretty sharply down, even though the market overall on the NASDAQ was strong. So kind of hyperscalers outperforming, picks and shovel trade underperforming. And we're seeing that again in Asia today. We're seeing that dispersion in Japan, where AI trade is really up to what the earnings come through as. So we see very strong earnings for MediaTek, for example. It's carrying Taiwan on its own. In Japan, you have this very sharp dispersion, Kioxia missing, but still trading kind of net higher because of the Friday rally, where it didn't trade. And then on the miss side, you're seeing Fanuc down very sharply. So Japan is very much a story of macro meeting earnings season. It's actually a very tough confluence for traders to trade at the same time, to have an intervention and a result season. And you're seeing some huge moves. Now, coming into Hong Kong, China, that's going to be interesting as well. Do the established listed LLM players struggle to keep up with this competition from unlisted massive players at the price range that DeepSeek is putting out there? Who can make money at those prices? How much demand do you need to make money at those prices? Very important. And then how do the Chinese semiconductor names react to the kind of pricing that they're charging? What is the go-forward market for compute if these models are so small and can be hosted inside companies as opposed to huge data centers? So how does that space evolve is important.
So you're watching the memory compute debate for China as well. What else are you watching for in the setup for Chinese markets today?
So how Alibaba and Tencent trade, right? Because for example, we had that story about renting compute, and Baba ADRs were trading quite strongly, 2% premium. Net, Hong Kong comes in today quite flat versus Korea indicating down 5%, right? So it's going to be very interesting to see whether the Chinese hyperscalers can continue to outperform, continue to kind of get some of this AI rent. That's the big debate in markets. Is the rent going to be collected at some point by all of this spending? And China might be the first place where that turns, because they've spent less money. They've been less extravagant in how much cash flow they put on the line. So are they going to get that money back earlier? That is going to be interesting to watch today.
Okay, Anthony, fantastic setup as we go into the open today. About 60 minutes away here to the opening bell. Anthony Stephens there. Right, just very quickly, we're looking at a 10-year yield. We talked about this. We are now testing the 1.7% handle for the first time, as you can see, in several weeks. Want to watch, of course, if you go into the open today. Coming up, talks are back on the table for U.S. and Iran here, with President Trump saying new discussions will begin on Monday. The details of why oil prices are tanking this Monday morning in the order of 4.5%, cutting down to the open of trade in Shanghai, Shenzhen, and here in Hong Kong. Futures are doing this amidst a wet, gloomy, dark, and depressing Hong Kong Monday morning. This is The China Show.
we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that. Save a lot of lives, save a lot of unnecessary power. To be honest with you, it would take many, many years to ever build it back. If it could, I don't think it would be even buildable back. So we had an attack that would be the biggest attack since World War II.
President Trump there saying new Iran talks will begin on Monday afternoon after he called off a planned attack, partially in response to pleas from U.S. allies. Bloomberg's John Herskovich joins us now. John, what do we know about the talks? What will these talks involve?
What we know about the talks is just what Trump said, which is very little. Neither the U.S. nor Iran have said that the talks are on. We don't have an official schedule for them. Trump has said that the parameters are going to be the familiar subjects of reopening the Strait of Hormuz and trying to end Iran's atomic ambitions. One thing separately, the New York Times reported some diplomatic sources as saying that there is some Qatari intervention going on between the U.S., Oman, and Iran. And Qatar is working with partners in the region, Saudi Arabia, United Arab Emirates. So there is this separate track. There's a diplomatic track which seems to be evolving, but the official talks just haven't, we don't have a time for them yet. And we've seen this play out before. Trump makes a threat of massive attacks, pivots, and then says diplomacy is back on. So that's where we are now.
I was going to get to that now, John. Like, why should we believe the U.S. president now? We've been here not once, not twice, more than that. So what's different about this time around is what I want to get to.
Yeah, no, exactly. It's the one thing that we have on the positive side is the prospects that there is a wide diplomatic effort that's going on, Qatar-based, but the actual chances for a breakthrough are slim. What we saw behind the pivot was that Trump over the weekend spoke with Saudi's Crown Prince, who reminded him of that the region is really worried about a wider war. In July, Houthi rebels attacked Saudi shipping, threatened to close the Red Sea, and America's allies in the region saw attacks on U.S. bases by Iran, raising the prospects of a wider war which could not only affect the U.S. military presence there, but also their energy infrastructure and hurt their economy. So the worries in the region were mounting about a wider U.S. attack and the blowback that would come to the various U.S. partners in the region. So I think that's part of what's behind it. But actually seeing some changes, that's another matter. As you said, we've been here before. The key issues remain, and whether there's progress on that, it seems like these are sticking points that don't have an easy solution.
So do we manage our expectations then of, a diplomatic breakthrough, John?
Exactly. The chance of a diplomatic breakthrough happens small. I mean, it's the same conundrum that Trump has faced in that when we had the ceasefire agreement, it was seen as a strategic defeat by many analysts for the U.S., but it gave Trump the chance to say that there's been a victory and to walk away. That sort of deal may be the best, maybe what the U.S. has diplomatically, and then the prospects of expanded military confrontation, which runs into the difficulty U.S. faces of depleted stocks of key materials such as Tomahawk missiles and air defense systems if Iran decides to launch ballistic missile and drone attacks on its neighbors. So, it's the key issues have remained through this entire period, and the prospects for diplomacy are there, but we've been here before and we've seen the results.
John, thank you so much for getting us up to speed on that story, with people waking up wondering why we're down about 4.5%, 5% on energy prices there. Very quickly, as we go into the open today, just under 9 minutes away, Hang Seng Index, so it's H over A, it seems, in the early goings. Platforms are catching a very strong bid. A full preview of the Monday session is just ahead. This is The China Show.
All right, aside from these DeepSeek and other AI model developments over the weekend, we're, of course, watching out for some of the macro data points as well. We have the private survey of manufacturing PMIs.
RatingDog. Yep, that's coming out in about 20 minutes.
I can't get used to saying that.
Yeah, the more you say, the more you get used to it.
It's going to take a while, I think.
One word, too.
Who remembers Tyson?
Yes.
This is after the official manufacturing PMIs, of course, already softened into contraction, right? That's based on the data we got last week. Aside from that, of course, we are watching out for how China markets react to the DeepSeek developments. Our colleague Anthony Stevens already flagging, right?
The platform companies are moving decently.
The cost benefit that they've been getting. So
yes, at some point the landlord's going to come to ask for the rents, right? And I think being economical, I think, is maybe paying off. So we are looking at some strength coming through there as far as Tencent goes. I think Baba's leading some of the gains early. Some of the other sectors we're tracking, so obviously chips and AIs, autos, that BYD sales number wasn't actually the most encouraging set of numbers juxtaposed against its full-year target. We'll talk about that in a moment. And, of course, the casino space, you have
bad weather.
Yeah, really bad weather. You simply have to look out the window and
World Cup distractions.
I was actually going to ask why you did not you brought the weather with you, but you left my favorite...
pandan cake?
Yes. Did you?
I did not.
Did not?
Bring any for you. Because you specifically said you didn't want...
I am now in a bad
mood.
I've
been banned from bringing pandan cake to the Hong Kong office.
It is
Anyway, aside from that, what else are we watching?
Because no one has it in... Correct me if I'm wrong. I always see it on the flight from Singapore to Hong Kong. You never see anyone partaking of it in the Lion City. I might have spent long enough in Singapore.
Maybe they're consuming it in their homes, right? So it's not out in the open in public.
You're
not spending enough time in the Lion City to begin with.
Okay.
To watch these consumption habits. Speaking of consumption habits.
Yes, let's have a look at Baba, Baidu, some of the chip plays as well on your screens. As we were just pointing out, platforms are on the way up. Some of the automakers, of course, BYD, some of its peers in the industry coming up on your screens. And, of course, what got us off track was this conversation on casinos, the bad weather. You had to miss, of course, on gross gaming revenue for the month. So we'll talk about that in a moment, including, of course, everything that we're tracking going into the opening bell today. You're watching The China Show. The Open is coming up next. Good morning. Welcome back. You're watching The China Show. We're counting down to the Monday open of these markets. As you can see, early on, it's H over A with some pressure coming through onshore. And, of course, we'll get to the details in a moment. But some of the big names, the OG tech names leading the rally here in Hong Kong, 0.4% of 1% of the upside on the Hang Seng Index. You're grinning.
OG tech names that have, been waiting in the sidelines.
Yes, the internet, if you remember that technology.
What is that?
Yes.
Anyway, we're seeing Hang Seng Tech. I think that is the early bounce that we're seeing, the internet platform names, as Dave was just alluding to. Of course, we're watching some of the AI hardware plays as well. Given this continuing debate when it comes to memory, compute, how much do we really, really need, right? Anyway, this is the open.
Deep questions.
DeepSeek, Minimax, ByteDance also in the mix. With all that, we're taking a look at how things are faring. And as early indications, this is really that follow through. You're seeing the outperformance from Hang Seng Tech on the mainland, though. That's where the pressure seems to be building up. Chinex also on the back foot, 0.9% down. And it's interesting, of course, coming against the backdrop of what we've been seeing broadly, this rethink on memory trades as well as the broader AI trades. Let's bring in our Bloomberg markets reporter, Anthony Stevens, for a look. So what are we watching? I mean, we're seeing that bounce when it comes to the old internet names.
Yeah, look, busy start again on Monday with the AI trade, and it follows into Hong Kong, China. You're seeing the disruption play out even in China from China's new kind of pace of LLM development. So the existing listed players struggling. Zhepu down 8.5% as it has to contend with DeepSeek's aggressive pricing. Does it increase the number of AI use cases, or does it kind of cannibalize existing demand? So far, the market's voting that it cannibalizes. Minimax, their new model, is very competitive with what has been released by ByteDance. It's at the top of artificial intelligence, kind of scores on video editing. The street is taking it really well to start outperforming the space, but that's only a small gain. For the hardware names in China, it's a little bit more complex. Is there more demand from all of these LLMs, or are they going to be more efficient and cut back the data center building? At the moment, that space has been under kind of pressure and trading with Korea. So flip the board to some more China domestic stories, returning to non-AI names. So the space in the EVs, has been a lot of debate around how much auto demand can there be in China and how strong is the upgrade cycle around EVs. There was some signs of hope on the latest monthly sales numbers, and that's playing out in share prices. We saw Citibank and Morgan Stanley come out to defend the space and try to talk about some selective buying opportunities. BYD, the market leader, trading quite well, and the rest of the space is kind of flattish. Now flip the board to the last kind of China domestic story that we haven't spoken about for a very long time, which is Macau. One of my favorite places in the world, but it's struggling as people cut back on visits to Macau, given the shocking weather we've had in South China and the World Cup. What's very interesting is whether Macau can also continue to break away from very muted China domestic retail and demand kind of drivers. So the luxury demand in China, the decline in luxury demand in China has been well documented. How much runway does Macau have when the Chinese domestic economy is struggling so hard?
Anthony, thank you so much. Asking the right questions there. Our markets reporter, Anthony Stephens, if only we had a guest who could help us discuss those questions. Anthony just laid out for us. We're looking at shares of Hang Lung as we go into the open today. Of course, the reported results, highlights on your screens, top line. You're looking at net income, underlying profit. Revenue is up about a quarter to 6.1. The dividend on your screens as well. Flip the page. The other thing we want to talk about too is the breakdown too, as far as I think it's net profit attributable to shareholders, just getting into the thick of things here. Talking us through all of this is the chair at Hang Lung Properties, Adriel Chan, joining us exclusively. Good morning. Nice to see you.
Good morning, David.
Good half? Question mark. How did it live up to your expectations?
I think it was a good half.
Okay.
So the top line numbers are not great, but that's primarily because we had a provision, which is a non-cash provision, really reflecting the slower sales in China than we had expected. So that is one thing which is weighed on our profits. But if you look at the underlying leasing profit, you look at the foot traffic, you look at the sales of our malls, actually it's pretty strong. So I feel cautiously optimistic. I think that it's met expectations. And of course, we have our new mall online in Hangzhou, which has performed, I would say, outperformed my own expectations.
And how much are you expecting Hangzhou to contribute to recurring income going forward?
So far, it's contributed about 37 million in rents. That's over 2 months of performance, which is not bad. I think in reality, it should ramp up quite a lot. Our sales are decent, but not fantastic. Couple million, 3 or 4 million RMB a day, which is sort of tracking. But I think that once the luxury brands open, we have a couple opening, and the rest of the mall opens, then we should increase that substantially. And I think that this will be on par with our second or third best projects, which are maybe Shanghai or Wuxi.
When do you expect, because you guys just opened that up, was it late April?
That's right.
When do you expect that to become fully operational?
So we're actually about 90% leased right now,
okay.
And we'll be opening the last 10% over the next few months. So we're actually moving very quickly on this one. It's relatively unusual, especially in this market, to open a mall with such a high occupancy.
What about the office component?
So the offices are a little bit slower.
Okay.
We were very happy to announce one of the 5 blocks was fully leased to one tenant at the time of opening the mall. But we still have 1 or 2 towers which are waiting to be opened. The other 3 coming along, but definitely slower than hoped.
So what's the path to stabilizing office rents in, say, the next 12, 18 months?
That is the question. If I'm honest...
Do you see a path?
I see a path. I don't know if it's 12 or 18 months. It may be longer than that in mainland China. It's been a very slow slog. It's been tough. And right now it's very much a price war game. So we're actually sitting at a very high occupancy. Our office portfolio overall is well above 80%. And I think that is very good for this market.
Does there need to be a bit more of a rethink then for the office strategy? Maybe repurpose it to retail, for example?
That's exactly what we've done for one of our office towers in Hangzhou. So one of them
more
will
to
be
come.
Exactly. So with services, F&B, nails, hairs, that type of thing.
Okay, the whole gamut. Yeah,
Exactly.
It's a full day. Do you get a sense there's some sort of permanence then to that? Is that a temporary pivot you're doing, reallocating those assets, or is that something you think you're prepared to?
I think given the path, the path we just discussed, which may be a longer path,
right.
I think this is something that we're really expecting to be more long-term.
On office, though,
Go ahead.
Are you seeing maybe any signs of AI firm expansion filtering in through office demand
Especially
in any way?
Hangzhou,
Yeah.
So Hangzhou is a city that we think is fantastic, both for retail and office. We thought it was going to be even better, but let's say the office market is still very crowded. So these AI companies usually have their own campuses. And so in the central districts, it's still hard to attract them.
Highlights for Wuxi and Shanghai for you? Anything that stood out?
I mean, luxury has performed decently. If you look at the LVMH and the Kering numbers, they have also basically shown what we've been seeing as well, which is that stabilization, no longer falling. But I think the luxury brands are still very conservative. We're still cautious. Consumer sentiment overall is still cautious. But what we're seeing in our sales numbers is that there's actually growth. So retail sales are okay. Foot traffic is at an all-time high. So there is this kind of bifurcation between sentiment and reality.
Right. And not to dwell on negatives here, but the impairment that you mentioned, people want to get a sense of, clearly things have been slow on that front for you to then realize it that way. Do you get a sense that you'll need to do more of that in the future? In other words, what are the plans for unsold inventory on that front?
The hope is that we won't, of course. We'd rather do these things once rather than multiple times. Same with anything along the lines of dividend cuts, or bad news is always better done once rather than multiple times.
Right.
But on that point, I think the China residential market, it's going to be quiet for some time. But if you start looking at those leading numbers, completions and also actually new starts, and the inventory that may be in the pipeline, it's looking like it's extremely low, perhaps even lower than the expected baseline. And so in a few years' time, who knows where that'll lead us.
So the inventory timeline workout, how much of a timeline are we looking at realistically?
For our portfolio, I think we're happy to let it sit until we find prices that match our expectations, which will probably be at least another couple of years.
Okay, let's let that soup simmer in the pot a little bit further. Can I ask you about Hong Kong? There's been a revival, certainly, of the housing market. There's a big project, of course, Northern Metropolis. On the latter, are you guys looking to get involved there? I think you've mentioned that you were looking for some metrics to show up tangibly for you to make that decision.
Hong Kong feels really good for us. I mean, I think that will ultimately include the Northern Metropolis. Short term, it's harder to say how that will pan out, but we're very bullish on Hong Kong. Last time I said that the residential was a little bit uncertain. We definitely feel better about that today. Property prices have gone up significantly in Hong Kong. I think it's something like 10% over the last year, which is incredible. And then volumes are at a 7-year high. So in Hong Kong, we're feeling quite good. We want to see it move into the luxury sector as well, because that's what we're more exposed to. But so far, the recovery in Hong Kong has broadly been mass market.
This is coming at a time where there's been a crackdown on capital outflows. Is that something that has been impacting luxury? Is that what's holding it back?
It is probably one of the things that's been holding it back. If that gets relaxed a little bit, then the hope is that luxury will come back. But I think there's still a lot of wealthy Chinese who have already moved their money, or who have already have their money offshore. And so maybe that will just take some time.
What about office here? I think the last time you were here, it was still a very long road to recovery. Have you changed your mind? Has anything changed?
Absolutely. Office recovery in Hong Kong feels very real. I mean, if you look at the rents in Central, they're up significantly. Occupancies are up. Vacancies are down. And so Hong Kong, it's being led by the core areas, which is Central, Causeway Bay. And the secondary areas maybe will a little bit slower to catch up. But I think that is definitely, the tone has changed again just in the past 6 months on the Hong Kong office.
Given the focus on Hong Kong, on the mainland as well, what is it going to mean for the business, especially at a time where there's a transition, there's a new CEO? I don't know if you'd be able to share at this stage, but Webelow is retiring October 1st.
That's right. And so we have a new CEO named to be announced shortly. And I think it's, there's no perfect time for transitions like this. Just like they say, there's no perfect time. You're never going to be perfectly ready for kids. And, you just have to make do with what you have. And I think this is an exciting time. There's going to be a more focus on operations, more of a focus on marketing. I think that our basics, our fundamentals are very strong. And so if we can execute those and speak a little bit better to the customers in China, then we'll be very strong.
Do you have a sense of when you guys will be prepared to announce who the new CEO? Is it weeks? Are we going to have to wait until the actual departure?
Watch this space. Watch this space.
Is it internal?
It is not, but it will be coming out in very, very soon, in a few days.
Okay, Adriel,
in a few days.
We'll watch the space.
Yes,
right?
we will.
Who the name is.
Yeah.
Thank you so much for coming in, sharing more
Thank
plans
you.
for the business for us. Adriel Chan is chair at Hang Lung Properties. And here's a look at how Asian markets are doing as well as we head to break, of course, on a day where we're already seeing a bit of the outperformance for the Chinese tech names. Not very much, though, actually. Hang Seng Tech about 0.75% higher. CSI 300 in negative territory. This is Bloomberg.
Okay, dollar yen. The biggest story across global markets as we go into a fresh trading week. You're looking at 4 days of perdition here if you're a yen bear. Positioning going into last week's intervention was extremely short. In fact, I think on aggregate the shortest the market's been in about 2 years or so. But yet here we are. And of course a massive move down in dollar yen. Joining us now out of Tokyo is Masahiko Liu, Senior Fixed Income Strategist at State Street Investment Management. Good morning, Masahiko. Thank you for joining us. Quite a weekend, I would imagine, that you guys had. What's the talk on the street now in Tokyo this morning? Where do we go from here?
I think we have seen, a lot of volatility in the past, 2 days. On Thursday, MOF, Minister of Finance, Japan came in and intervened. And then on Friday, you have seen the joint intervention between, New York Fed and also Japan, right, MOF. And this morning, dollar yen probably potentially seen another bout of intervention that brought dollar yen, weaker. So yen strengthening 1% versus the dollar. And I think this will continue for the foreseeable future. And I think the signaling, in fact, is there, right? You have the Fed coming in, essentially trying to help Japan. And we have even seen, President Trump, tweeting out saying that, he's doing this for, friendship of Japan versus and U.S. And Scott Bessent is the, I think he's mastermind behind a lot of this, right? Trying to push out all the signaling. In fact, I think there's a lot of things that is interesting in the market that everyone is looking at now.
Yeah. Talk to us a bit more about that, because it's also the idea that the ructions in Japan's JGBs or even the weakness that we've seen in the currency is becoming an issue for the U.S. How much of a paradigm shift are we seeing now that the two sides are working together?
I think, the thing about Japan is that it holds a lot of, foreign reserve, right? Whenever it intervenes, what does Japan do is they have to sell something to intervene and buy yen and prop up yen, right, and sell US dollar. And the fastest way is to sell US treasuries, right? I think that creates some funding problem in the US market, right? It's not that significant yet, but then, with Japan drawing down its reserves, every time it sells dollar yen, they intervene in the bulk of, 35 to 50, 60 billion dollars. That's a lot of money, right? And by doing that, that will create some spillover into global bond market, including US. And this is at a time when it's very sensitive, when everything, a lot of this curve in the global market is steepening. And there's also a concern on central banks globally falling behind the curve, like BOJ, right? I think, having the signaling effect is very important. And one thing that market has, overlooked is, I think, this FEMA repo facility that Katayama, which is the finance Minister of mentioned this morning, is very, very important. FEMA repo is essentially a repo facility that, any central bank, so central bank with a repo swap line with the New York Fed can actually tap the New York Fed to get US dollar funding by pledging in US treasuries that they hold, right? So this is essentially being able to intervene in the market without really physically selling U.S. Treasuries. But the signaling effect is the most important effect here. This has happened in 2019 too, right? We have seen the U.S. dollar funding stress in the short-term market when there was a lot of broke down in the market, and New York Fed came in with this FEMA repo introduction, and that calmed the market down. I think this time now, it's a very, very smart move from U.S. On Besant and also Katayama to actually tap on the wire to signal the effect that they will be able to use the FEMA repo, and then this is more of a signaling effect. But nevertheless, they're trying to get the biggest bang out of the buck, right, with whatever tools they have on hands.
Yeah, that's important. I think, to your point, it does align, U.S. interests not to see yields pick up even further, and of course, on the Japanese side, stabilizes the yen. So it does seem they're bringing out more tools, or being more creative at least. Can I just ask you a direct question? Do you think the top is in on dollar yen? Was it 164, 165? Do you think that's now a thing of the past?
I think so, right, for this current juncture, right? Unless U.S. has a lot of, hyperinflation, and then if the Fed were to price, another, so a big Fed hiking cycle, 4 to 5 hikes in the market, I think we have probably seen the top in dollar yen, right, at 164-ish. And now, the next level to watch is actually not on a weaker yen, but a strengthening, right? I think 155 is the level that market is watching. Why is it? Because 155 is essentially the resistance or the support level that market has seen yen weakening post the May intervention from MOF.
What about the interplay with, say, carry trades aside, or maybe doubling down on that, what are you seeing versus Chinese bonds, for example? Just looking at FX levels, you're looking at yuan versus the yen. They're looking quite oversold. Of course, we've been seeing that sharply lower. What are you watching going forward, especially at a time where we're trying to digest what's come out from Chinese authorities as well?
I think, the yuan story is a different story from Japanese yen, right? Yuan is essentially, China is basically, experiencing the whole Japanification thing, right? 30 years ago when Japan had the whole thing, when Japanese yield went to 1%, and then it continues to drift lower. And looking at, say, GB yield, right, it's around like 1% handle, 1.5. And then yuan is actually strengthening versus other currencies. I think, this is what happened in Japan too, right? And then I think Japan, yuan Japan will continue to stay at that level. But then, cross yen-wise, we have seen a lot of tops, right, in the market, like euro yen. Interestingly, last Friday, the Fed came in and they intervened in euro yen instead of dollar yen. I think that's basically signaling to the market that, they don't want a broad, it's not, them preferring a broad US dollar weakness, but rather than, putting a stop on how much yen can go weaker from here.
Masahiko Liu, thank you so much for taking the time. I know it's busy, so we'll let you be senior fixed income strategist there. Thank you so much again. Out of State Street Investment Management in Tokyo for us, where it's ground zero, really, for global markets this morning. Just very quickly, the private survey out of the manufacturing, this is the PMI numbers. This is for the most recent month. That's for July, so it's also a miss. As far as that's concerned, 50.9, we were looking for, at least analysts were looking for, a 52 handle as far as that was concerned. Lots more ahead. This is Bloomberg. All right. Welcome back. We're just revisiting parts of this equity market. Start things off with the oil and energy counters on the back of this drop in oil prices. We're down about 4 or 5%. Shanghai crude's down about 3.5%. From PetroChina all the way down, of course, to CNOOC and China Oilfield Services. Nuclear is going the opposite way. Let's get that up, please, if we can. And quite a big move there to the upside, and some of the also energy names, of course, in the order of about 2 to 6% on the back of what? It's about a fairly sizable number, 25 billion as far as plan is concerned, as, of course, they're looking to supplement this soaring demand for energy there. We're looking at the equity markets as we get underway this week. It's worth pointing out in the early going, so we're looking at very noticeable moves in your platform companies. So Alibaba's up 6%. Hang Lung, which we just had a conversation with the chairman earlier on, they've reported results, also up about 4.25%, 1%. Tencent is also seeing some gains here in the order of 2.7%. So Hang Seng Tech is the outperforming group today. Very quickly, we do have, of course, this the launch of bond futures here in Hong Kong, and some lines coming through here out of the CSRC. Wu Qing, who is talking about this open of bond futures in Hong Kong today.
Yeah, so begin trading today, and I think this is the third attempt. They're trying to use a hedging tool to further open up the country's debt markets. So certainly something that we're watching against the backdrop of these signals that we've, of course, been getting out of the Politburo as well, and the PBOC, right? Seems to be more commitment to implementing whatever's been previously announced already.
More forceful measures with lots more on the way, including, by the way, a look at the Chinese economy. All that is coming up next. This is The China Show.
Welcome back to The China Show. Here's a look at the Hang Seng a half hour into the session on what seems to be quite a cloudy day. I mean, we look at markets, though. I think there's a bit of a brightness to start with. And this is led by some of these Chinese internet names on a day where I guess investors are digesting these DeepSeek developments in the way that how much does this impact the costs for them, the payback, the investments that they've put through so far, along with how much compute and memory demand this actually informs for the broader market. Of course, a lot to do with the memory trade, right? And how there was such a violent reaction in the month of July.
Yeah. I mean, artificial analysis, which a lot of folks turn to, you know, if and when and whenever you get these new models, of course, being made public and their sort of spectrum of who's doing what well in terms of intelligence. And, of course, there's a cost component there. We'll be joining us, of course, in a couple of minutes to help us understand really the latest and the trends that they're seeing in as far as this is concerned. But yes, we're trying to figure out. The market is currently doing that in the form of bidding up the platform companies here in Hong Kong, where you have Baba up 6. Tencent is up by about 3 points today. Baidu's also not far behind where you are with Alibaba. So you are getting a bid across some of the Hang Seng Tech names. Should be coming up on your screens very shortly. Thank you so much. There we go. So it's worth pointing out, I think we are up 4 weeks in a row now as far as Hang Seng or MSCI China is outperforming the S&P 500. Certainly that is a trend that has obviously lasted more than usual. Let's flip the page, please, and have a look at other markets trading across the region. Of course, the Nikkei is front and center, given, of course, number one, we have earnings. Number two, you have the macro and yen intervention, of course, playing a big part in how that market is trading today. Taiwan is up 1%, did open slightly to the downside. And Asia-Pacific, all things equal, down about 0.6 of 1%. Kospi, of course, very much still front and center. Historic day on Friday, we're giving up part of that, not all. We're down about 4 on that. Sidecar, of course, and the Kosdaq in the last hour or so. And SK Hynix and Samsung down about 7% each on those. Right, a look at the currency markets with, does that intervention on the Japanese side of things then effectively weaken dollar across the board? What does it mean for funding currencies where, of course, the story has been increasingly less the yen as a funding on the carry? And do you turn your attention to, you know, dollar China right now? And I think the Japanese 2-year yield is at 1.2, 1.53. The Chinese 10-year is at about 1.7. I mean, not that apple to apples, but they're close, right? Borrowing costs. Dollar yen on your screens, 4-day look and how that looks. And so we've taken out the 200-day moving average. We're bouncing off a little bit going into this hour. 156.44 is the current level here on dollar yen.
Yeah, let's see whether they get it below 155, right? That's the other level we've been watching.
Then I'll cancel my trip to Japan. That's my line in the sand.
I'm surprised you haven't already changed whatever money, you're required for.
I know, yeah. I'm not allowed to trade FX because I don't know how to. Yeah.
Anyway, someone who used to trade.
Yeah, that might know. Yes.
David Savage, Bloomberg MI strategist, joins us now. So, Dave, we've been seeing David Savage, sorry. Not
Yes,
David.
no, I was about to jump in.
We've been seeing, I mean, the market's expectations of maybe not just the level of support of intervention from the US, but also whether the BOJ might pull the trigger and hike earlier. That seems to have shifted as well. Well, what are you seeing out there?
Yeah, I think that's a big key, right? That I think we've seen, intervention alone from Japanese authorities has sort of been insufficient to kind of stop this upward push in dollar yen, but certainly coordinated intervention, with the U.S. has been, a different story. And now if we're starting to hear rumblings that perhaps, we're going to get more hawkish tilt from the BOJ, I think that's where you start to get a more sticky move to the lower side for dollar yen. Because again, if this is just intervention, then I think, in the short term, I think that's going to keep traders away from really pushing, the yen further lower. But I do think if you get, BOJ, coming in more hawkish, then I think that's where you start to really see some bigger moves. And so we are seeing, it start to creep up, right? I think October's priced about 90%, and September's even a coin toss now. So certainly moving that direction.
What does it mean for equity market investors this week?
Yeah, I mean, it's coming alongside another big week of earnings. Certainly in Japan, we've got Toyota on Tuesday and SoftBank later. But I think the U.S. side is also going to be very interesting to watch. We have AMD earnings, and then of course SpaceX. And I think SpaceX is certainly interesting. It's off close to 45% from its peak, and just because of how tight it got into sort of that retail momentum trade, it's going to be interesting to see where the earnings come and what that does to risk sentiment, particularly because it's also shortly after we're going to get a very large stock unlocks. So I think that could be a real risk for sentiment when we're already seeing the momentum trade is certainly fragile.
And it's already below IPO price, right? I mean, how far can it go? But talk to us about the specter of how we've been seeing earnings. They've been holding up quite well. I mean, the hyperscalers, look at Amazon, right? Microsoft as well. But then the market reaction, less a lot to be wanted in that regard.
Yeah, I think it's sort of a story of two sides, right? So you had, I think, SK Hynix and others that posted really strong earnings, but it didn't meet expectations, and so that kind of brings up that risk of, have those earnings expectations that make valuations look so attractive, have they run too far? Are they too optimistic from where reality stands? On the other side, you had US hyperscalers that largely delivered, particularly Amazon and Microsoft, and that really pushed that, squeezed the momentum trade that had been really battered higher into the end of last week. So I think in this week, it's kind of setting up a fairer fight, and we're starting to see the momentum trade kind of slipping again with the memory trade coming off. So I think, again, the real risk, SpaceX and then AMD later, it will be interesting to see if that kind of hits sentiment again and you get kind of another leg lower.
Korea is, interesting is not a strong enough word there. I think, to your point, on Friday was first a historic price rally. That was a day after retail investors got forced out of their positions. You saw a lot of foreign funds buying in. At the end of the day, your institutions win again, and the retail was left. Well, I guess the point was in the same breath as have we seen the bottom on the yen, have we seen a bottom now? Can we look at that as a sign that the Kospi's bottom's in?
I think it's hard to say because on the one side, often the biggest bounces you get in equities are in bear markets, right? So I think we saw that certainly, perhaps positioning had gotten too stretched, and then you got the catalyst, which was Microsoft and Amazon earnings that really squeezed it higher. I think, with realized volatility in Korea, basically at 100, I think it's going to be a real challenge to start to see institutional investors really come back in. And with retail that's been really hit in this sell-off, how optimistic are they going to be to come back in force as well? So, probably the worst of the deleveraging that we've seen is kind of through. But do we really see momentum kind of inflect higher in the absence of another catalyst? I think that's going to be difficult, particularly with the DeepSeek news that we're all trying to still digest.
That's true. That's true. There is that component still that continues to move underneath the hood. David Savage, thank you so much, our MLive strategist there. Just ahead, in fact, I'm glad David ended on that note. We'll deepen the conversation on this AI race between U.S. and China. And as that heats up, Micah Hill-Smith will be joining us, co-founder and CEO at Artificial Analysis will be joining us in a couple of minutes here, and really to talk us through who is topping their leaderboard currently, why that's so, and how we see that changing perhaps in the weeks and months ahead. That's coming up next. This is The China Show.
Welcome back to The China Show. Time for our China Decoded segment, and we're taking a deep dive into the competition in AI models. We saw some AI releases out of China over the weekend, and it includes an updated model from DeepSeek, the V4 Flash. Let's bring in our China correspondent, Min Lo. So, Min, how's the performance of the upgraded model so far?
Yes, the upgraded model has significantly better performance, better autonomous agent sort of capabilities. And if you look at this ranking on the artificial analysis leaderboard, you can see that the score on artificial intelligence used to be 40. It's added 10 points. It's now 50. So ranking right here. It still trails behind Kimi K3, which is the top 3. And Kimi is still seen as the market leader in China right now. Of course, Cloud and GPT are the first 2, but it's edged out Alibaba's Q1, Minimax, and even the DeepSeek V4 Pro, which is the full-fledged model. So it's quite significant that the Flash model, which is a smaller size, more nimble sort of model with less latency, actually outperformed the original full-fledged model. So this is quite significant. But what is unbeatable about DeepSeek is the pricing. So if you flip the board and look at the cost, DeepSeek is now the cheapest model in China. Right over here, DeepSeek V4 Pro, just 5 cents per task versus Cloud Fable 5, $3.15 per task. So this is a 60 times difference when it comes to the cost difference. And that's for the V4 Pro. The Flash, according to Caixin, DeepSeek has cut the prices for that by up to 50%. So significantly cheaper. And you put those 2 charts together, and we plot into the next. If we flip the board and take a look at the next chart, you can see that here you have the intelligence versus the cost, and where we want to be is right here at the top left quadrant, right? Where you're cheap and you're intelligent, and DeepSeek is absolutely dominating. Cloud, of course, a little bit more intelligent, but a lot more expensive. So again, when it comes to market adoption, especially for smaller or mid-sized companies that may not be able to afford so much, DeepSeek is going to be the perfect choice for them if they want to especially think about adopting and hosting this model on their own instead of renting from hyperscalers. This is where DeepSeek has a huge advantage over the other frontier models from the US.
Yep, cost. I hear you saying that so many times. Min, thank you so much for doing the Van and White for us, our China correspondent, Min Lo. And joining us now as well, Micah Hill-Smith, co-founder and CEO at Artificial Analysis, an independent evaluation platform that benchmarks AI models and API providers. Micah, great to have you on the show. We've been, really looking forward to your analysis. Give us your take on, V4 Flash. Does it stack up when it comes to, obviously, when it comes to costs, it compares, but talk to us about speed, intelligence, and some of these other metrics as well.
Absolutely. Hi there, and great to be with you. So first, Artificial Analysis is, as you said, an independent AI benchmarking company. That means that what we spend our time doing is building the infrastructure, tooling, and data sets to measure how smart these AI models are and look at how much they cost and how fast they are. You've actually just gone through probably the most important 2 metrics that we currently report on and why they're important for the new DeepSeek V4 Flash model. So we've got our intelligence index that you were just looking at, and then we look at this cost per task metric, where we're looking at how much it cost us to run each individual task that makes up that intelligence index when we tested the models. So that intelligence index, it's what we call our synthesis metric for how smart the models are. It's a surprisingly useful simplification to just think about all of these models as on a spectrum of how smart they are. Within a few points of difference for different use cases, there are going to be advantages and disadvantages. But once you're more than 5 or 10 points of difference on that intelligence index, you'll always prefer the smarter model to the less smart model. And then you're just trading off which is the smartest you can get for a particular cost.
Okay, understood. That's interesting because I do want to ask you though. So the difference between say 59 and 60 could be negligible depending on, of course, your need. It becomes hard to ignore if it's a 10-point difference. I guess if you could simplify that even further for us in terms of what is a 10-point spread between where you are, say, with Anthropic's model and, of course, this latest DeepSeek iteration. How different are these models specifically?
Yeah. So, look, the first thing I'll say is that while it's pretty nuts and quite profound what today's AI models can do, the way we look at the world is that 99% of the tasks that we would foreseeably want these models to do, they're not yet capable of. So that means that there's a lot of demand for usage of today's AI models that is concentrated around the latest and greatest, because there are so many tasks that are only just becoming possible. Some of the examples that are often given of this are things like supporting with scientific and mathematical research, but there are much more practical things like making slides. A fun fact is that it's a slightly stylized statement, but pretty precisely accurate, actually, that 6 months ago, the AIs weren't smart enough to make a slide. I'm just talking about a PowerPoint slide that you'd make it work for any kind of presentation. And over just the last 6 months, as we've climbed from 40 to 50 on our intelligence index up to that 60 plus, we've seen models that are now remarkably capable of making slides that are being used in corporate presentations all around the world.
Micah, sorry, I might be going a bit off tangent here, but when it comes to some of the other metrics, is security also part of what you're looking at as an analyst? I mean, we've seen these cyber failings for OpenAI, for Anthropic. And if it is not, should it be part of how we assess these models?
Yes. So the significance of the models for cyber offense and defense is an incredibly important topic that we and everyone in the industry are thinking a lot about today. Some of the significant events that we've seen in the last few months have been as these models have achieved greater intelligence and greater performance, especially for software engineering work, we've seen them also get better at finding vulnerabilities in software. That's useful if you want to patch your software and make it more secure. It's unfortunately also useful if you're trying to hack into someone else's software. That's where a lot of the interest from the US government has really stepped up in the last few months has come from. There was obviously a lot of interest in Anthropic's Mythos model earlier this year, and we've seen significant software engineering and cyber capabilities in models, not just from Anthropic, but from OpenAI and several of the leading players in China in recent months.
And it might be early days on this because this is something, to Adriel's point, and you brought up as well, Micah, that the industry is now just only starting to think about. Is there a trade-off between intelligence and security?
That isn't I wouldn't think of that necessarily as a trade-off. What we generally see is them going together. There's a lot of effort. There's a lot of talk today about wanting to make models safe and to have safeguards on them so that they can't be used for things that we don't want the models to be used for. I wouldn't say, though, that it's clear that that's a trade-off. It's that the models get more useful for both cyber offense and defense as they get smarter overall, and then we're thinking about safeguards on top of them. The most important trade-offs that we think about are normally between intelligence and cost and speed, exactly as you were showing just a second ago on that intelligence cost chart. If it'd be helpful, that chart is actually the absolute best chart to talk about why DeepSeek's Flash model from last week is a significant release.
Can you talk to us also about what you're hearing, say, among developers? Because from what we understand, the compatibility between DeepSeek and what we're seeing in OpenAI users, that seems to also enhance the usage, the uptake for DeepSeek.
Yes. So this actually goes to the whole reason that it is helpful to look at that intelligence versus cost per task trade-off curve. So there's a way of analyzing this market that at the model layer, these models are highly substitutable. And so all we need to do is understand these several metrics about them. And beyond that, while there might be some style differences, overall, we can say that we can swap out a model that scores a 50 on the intelligence index for a different model that scores a 50 on the intelligence index. And if it's lower cost for us to use, then that's strictly going to be good. That gets us to why the DeepSeek models are significant and why it's so easy to switch them out for other use cases. So while it might be the case that for many use cases we are getting significantly better quality of outputs from these most expensive models, there often isn't a high degree of technical complexity to switch to a model from a different provider.
You know, there's the notion that Chinese models are catching up with the U.S., I think just looking at your scores is quite apparent, but I suspect it's a lot more nuanced than that. How would you describe the relative rate of improvement across both sides of the Pacific?
So I think the important thing in that statement is that the idea that the models are catching up implies that something has changed from where we were in the recent past to today. What I've been saying in conference presentations and interviews over the last couple of years has been that we consistently observe an approximately 3 to 9 month lag between a US lab achieving a certain tier of intelligence and a leading Chinese lab achieving that same tier of intelligence. Overall, our opinion at Artificial Analysis is that the current models that we're seeing, including Moonshot's Kimi K3, including DeepSeek's new Flash model last week, are not breaking that trend. I'll give you that 3 to 9 months is a reasonable range, and there's some significance in where we are on either side of that range. But we've been plotting for years now these charts of the US frontier versus the China frontier versus the frontiers for the leading labs in other countries around the world. But as I think we're all quite clear looking at this chart, all of these leading models that we're looking at are from the US and China. We've been plotting these lines of the frontiers of the level of intelligence that they've achieved over time, and there's always been this gap between the leading US model and the leading Chinese model. And when you look at the chart, when you zoom out, I struggle to see a significant trend that has changed in the last couple of years, even if there are these moments along the way where there are these particular days after models come out where it feels like that might be the case.
Micah, just hold that thought, because it's almost like the news gods are raining down upon us right now. We're just hearing some breaking news that Alibaba is releasing its new Q1 3.8 Max AI model, 2.4 trillion parameters, and according to Alibaba, I'm just browsing through the details of this one. It has the same performance. It has, okay, just to use the phrase that the company's using, Anthropic tier performance in terms of parity here. I mean, Micah, without having the benefit of having seen the details of this, I just want to get your initial reaction to this. We're also just seeing this right now.
Yeah, okay, very, very happy to. So we haven't yet got a score that I can talk about on this model, but let me put it in some context. So first, Alibaba has consistently been one of the Chinese AI leaders over the last several years. Their Qwen family of models includes a wide range of open weights models that they've consistently released and some proprietary models that are served on the Alibaba Cloud service. We have consistently seen, especially the open weights models, often be on various Pareto frontiers that we track over time and get significant uptake for different use cases. As of today, I think we have Alibaba in 4th place before the release of the model that you're just talking about out of Chinese labs, with Moonshot AI, ZAI, and DeepSeek being the labs who are currently ahead of Alibaba's latest model. The new model they're talking about there sounds like they've just announced that it's 2.4 trillion parameters. That is quite large. Right. So to put that in context, Kimi K3 is one of the largest open weights models released to date at 2.8 trillion parameters. GLM 5.2 is less than half of that. And the DeepSeek Flash model that we're talking about is only 284 billion parameters. So we're talking about a model that is an order of magnitude smaller than the new Alibaba one. That doesn't necessarily mean that it will be more intelligent. It means that we know that all other things being equal, it's going to take more compute to run and therefore be more expensive to run per token. What I would assume Alibaba are hoping for here is a model that they can get to be competitive with Kimi K3, the very large moonshot model that there's been so much excitement about over the last couple of weeks.
Micah, talk to us also about how all this informs the future of open source AI models, that they've been able to, really do this as well with these export controls underway by the US.
Yeah, so first, just a general comment on open-weights AI models. When we talk about open-weights, we're talking about the company that created the model giving away a copy of the model itself so that others can run it. Often this is associated with very permissive open source style licenses, so there's not necessarily any payment to the company that created the model when others are running it on their hardware. There's not necessarily anything special about building an open weights model versus building a proprietary model. It's just that after you've made the model, you give away a copy of it. We have consistently seen the leading Chinese AI labs be much more willing to give away a copy of their model in the last couple of years than the leading US labs, who have focused more on proprietary models that they serve via API. Some of the leading US companies have released open weights models, including OpenAI's GPT-OSS model, Google's Gemma family, NVIDIA's Nematron family, but typically we haven't seen those models be right at the top of the charts as the most intelligent open weights model at any given time. I'd say that we continue to see this as a consistent trend that the leading Chinese want to do this.
Micah, more to watch, and I won't keep you anymore. I know you have probably something to do now. Thank you so much for the time there, Micah Hill-Smith, co-founder, and what a time to have the conversation with the CEO of Artificial Analysis.
All right, we're watching Tokyo markets, of course, very closely. They're about to head to a break in a minute. We are seeing the down day. And of course, this is a function from what we're seeing in the Japanese currency surge, especially against the greenback. We're seeing it moving towards the 156 handle now. And that's hitting, I think, the export-related counters on a week where, of course, earnings is front and center as well. So you marry the macro with the micro here. And of course, these tech developments coming out of China, the extent in which maybe that affects some of the memory trades. Of course, we also did get the likes of Kioxia, right? The earnings, the outlook disappoint. So maybe that also throws a bit more question marks into where things go from here. But of course, watching what we're seeing in JGBs, that pressure is coming. Seems to be that repricing underway for what the BOJ might do, Dave.
And it looks like, I think, if I remember correctly, what David Savage just said, I think it's almost fully priced for the coming meetings in September. So that's something certainly we'll watch that comes against, Adriel, I think, described it perfectly, this marrying of the macro and the micro with the earnings story, of course, this week. We'll hear from Toyota, of course, which is a very big exporter out of Japan, of course, what the FX lift has been for them. For every 1 yen move, that translates to quite a substantial pickup, of course, depending, of course, on what the move and direction of the move is. But yes, we'll hear from the companies this week out of Japan on the earnings front. Also, just to touch on the rest of the regions looking like this, about 0.9% to the downside. It's one of those days when looking at the benchmark might seem slightly misleading because you are getting a massive pull down from Korea. But Taiwan, last we checked, is up. Hong Kong is doing decently well. And Japan is basically playing the political game and not doing anything. S&P futures are up 0.5%, which is a good thing. Not on your screens, but I can also tell you European futures are also pointing to perhaps equity markets shaking off the early cobwebs as we go into the thick of the Monday session. PMI numbers came out. These are the private survey. RatingDog came out about 45 minutes back. Also a miss as far as that was concerned there, Adriel.
Yep, and this is following on from recent pledges, policy announcements out of Beijing already. In a statement, the PBOC said it's ready to adjust monetary policy to support the economy if needed. Meanwhile, Premier Li Qiang also talked about powerful measures to boost consumption. And separately, China approved a $25 billion plan to boost the nuclear industry. Let's bring in Eva Li. She is chief economist at Huatai Securities. So, Eva, your first take of what we've been hearing from last week, the signals into this week as well, and then the data that shows us, maybe manufacturing needs a bit of help.
Right. I think from the Politburo meeting, they're usually quite balanced in their assessment of the economy. So this time, they're still pretty sober about the external environment being volatile, domestic demand needed boosting. But the tone, I must say, if you examine the past 5 to 6 meetings, it's a little less urgent in terms of boosting growth or counter-cyclical management. Because as Premier Li Qiang always emphasized boosting domestic demand policies and boosting cyclical management policies. But that's the job of the State Council, because we want to keep growth within range. And second quarter growth was 4.3. But if you read through the script, they've been quite positive on the structural transformation that China has embarked on. And they're pretty happy with the supply side reform. And they actually mentioned high-quality growth and optimizing supply as well. So in terms of policies, I feel like there should be a catch-up in terms of fiscal expenditure that contracted quite a lot in the second quarter.
That's right.
Yeah, and they will remain flexible to external shocks. But let's be honest, China has seen many external shocks since 2025. And if we look back on fiscal and monetary policy, they've been within a pretty tight range. So I don't expect them to step way out of the range in counter-cyclical policies in the second half of this year.
How do they... so you mentioned there was a contraction in fiscal impulse in the second quarter. How do you think they shift that in the current quarter? Do we see that pick up?
I think the main effort will have to come from the central government spending for two reasons. Number one is local government financial vehicle deleveraging is still ongoing, and you can see that local government are still self-disciplining in terms of expenditures. And there's the local government political cycle coming up, which would keep them probably pretty disciplined going into next year. But central government-wise, we're also behind schedule in terms of annual spending budget. And in the Politburo meeting, they did mention to speed up the investment in strategically important projects, as well as AI Plus and 6 networks. 3 of them are AI related, by the way, the construction of those. So I think if central government spending start to step up to try to meet the annual budget, which they usually do, fiscal expenditure should moderately pick up somewhat in the second half.
What shape or form do you think that spending from the central government will take?
I think, first of all, we're behind schedule in disbursement this year of the annual budget. They should step up a little bit into the second half. We will still see central government and local government funding sort of combined for some of the important projects. And we also saw news about speeding up, as I mentioned, 6 networks. 3 of them are AI related: new energy network, new telecom network, and new compute network. We're probably going to see funding tied with those as well. Yeah, and local government-wise, their hands a little tied with the ongoing deleveraging effort, as well as a decline in local government fund income from contraction of land sales this year. So less capability to do that from the local government.
Anything we should expect on the consumer targeting side as far as some of the fiscal help is concerned?
Yeah, there are conflicting messages from the Politburo. So I would say the underlying tone is to adopt only pragmatic and proven to be effective policies.
Sorry, the subsidies?
They did say proven to be effective and pragmatic. Let me break it down for you.
Go ahead.
So number one,
I get too excited when I hear about it.
Subsidy, yay. But service, they did mention that we need to dig deep on releasing the potential of service consumption. That doesn't sound like a big stimulus, but just to go with, whatever, I think that part of consumption that's growing above trend, we need to promote that, a little bit of tailwind, but not too much. But pragmatic and proven to be effective, if you break it down, pragmatic meaning, number one, within the realm of capability, fiscal capability. Number two is, in terms of effectiveness, if you continue to subsidize large ticket items, we all know that the marginal effect will fade out over time. So that doesn't really fit the description of proven to be effective. I think they should expand the scope of the subsidy. There should continue to be some subsidies, especially AI plus and health-related like gadgets and so on. But I don't see the dollar amount being much larger, or maybe doesn't even match what we saw last year.
I suppose, stepping on your point a little also, is there a need to, I guess is our question.
Yeah.
Because we look at AI and how it's affected economies.
Right.
The K-shape is developing everywhere, right? So how much of a need for the bottom half of the K in China?
Well, there's need for the bottom half of the K everywhere, but in terms of the AI impact on growth, because Chinese companies are open sourced and there's the profit margin naturally are much lower for the large language models in China. So from a macro point of view, the benefit is more dispersed. We do see more 2C and application than we see in the States to some extent, because consumers or individual or self-employed people are picking it up much quicker in China. So in terms of income redistribution, I think China is still going to leverage on the corporate side and to improve the supply side, to make it in terms of more perfect competition, lower entry to barrier to entry, and so on. But China has not in the past, even during COVID, relied on the demand side for income redistribution. So I don't see that being the theme of the second half of this year either. Just to one thing that worth mentioning is that the high base effect from the trade-in program is going to start to fade in the third quarter of this year, because the peak of it was second quarter of last year. So we're going to see headline retail sales looking a little better anyway. So sort of reducing the need or the urgency for even bigger sort of stimulus in consumption.
The big picture to the point you made is, how long do we have to wait for inflation to pick up, whether that's because of supply side reform or some of the other industrial policies that are putting in place? Because the bond market seems to be signaling that that's not going to be the case anytime soon.
Yeah.
And, if you're somebody in the market, you're looking at a bond yield, do you need to be worried about the prospects of the economy simply looking at the yield that's been tricking lower and lower?
I think the yield is reflective of a couple things. First of all is, as we mentioned, the fiscal discipline, or the fiscal expenditure growing below target and way below target for the local government.
Okay.
And the bond issuance has been behind schedule for local government as well this year. So the supply of the bond is less, and people expect less stimulus, especially in reaction, as you can see, to the Politburo meeting. People expect steady policy rather than stimulative policy in the grand scheme of things. How worried should we be? First of all, in terms of the headline number, we did see nominal GDP growth going back to 5.9% second quarter. GDP deflator turning positive for the first time in 3 years to 1.5, although a lot of people say it's oil related. But in a globally inflationary environment, China as an oil net importer reporting corporate profitability looking better in the second quarter. Net is still, I think, read as a positive sign for the central government. So in that sense, I think China's probably just going to ride on the global inflationary wave a little bit, continuing, improving on the supply side as well as unifying the market and so on, and continuing to push forward in terms of deleveraging and risk prevention for the property and real estate market. If we didn't, I think the risk net of deflationary pressure is smaller than 2024. Let's put it this way.
Okay.
Because globally, the environment is much more inflationary right now.
Okay. That's a good thing. We keep hammering about trying to place the long game, and then we look at the economy, look at it from a short-term lens perspective, and lose sight of the message. Thank you so much.
Thank you.
Very nice to see you, Eva Eder, Chief Economist at Huatai Securities. Okay, let's turn attention back to Japan. Now we're getting some headlines coming through, and the finance minister is speaking. That's present tense in Tokyo. And, okay, so I think context is important here. So there was intervention last week. There is speculation that they may have come in again this morning. And what they're saying is they're not commenting on whether there was intervention on Monday, but they will not hesitate to take any further steps in the FX markets at any time if that is, of course, necessary.
Yeah, and further context, of course, it's the IMF rules, right?
Yes.
The power of three. So
yeah, there's a limit.
There's an expectation, I guess, in the market that today they act as well, following on from what we saw in the past two sessions already. Of course, it's also maybe shifting the expectations overall of what the BOJ might do. So watching JGBs as well. Yep. Katayama's strong verbal intervention, won't hesitate to take FX steps at any time. We'll continue tracking these moves in FX. This is Bloomberg. We're talking about casinos now.
Your favorite place in the world?
Not mine. It's Anthony Stevens' favorite place in the world.
Disneyland.
Macau casino stocks. Anyway, we did get some of the data, right?
Yep.
So gaming revenue out of Macau, that fell 8.4% in the month of July. And this was a decline attributed to travel disruptions from a typhoon. There were also some of these distractions from the World Cup. Bloomberg Intelligence sees the city's gaming revenue resuming its recovery after the event. Our analyst, Peter Tang, joins us now. So what's your take on the performance for the month of July?
Right. Well, so July numbers came in down 8.4% year on year. So that's actually a little worse than consensus, around 6%. But if you compare the July decline, it actually narrowed versus what we saw in the month of June. And if you look sequentially, there was also about a 9% improvement between July and June, indicating that some of the volumes, have started to pick up post the World Cup.
Anything that stands out to you, though, that might explain, I guess you touched on a few of these already, that might explain the bigger than expected
I think
the gap there?
This time round really was the impact of the World Cup. And I think speaking to executives in Macau, they even alluded to the fact that the impact was greater than even what they expected. So as we wrote in a piece before, this is an expanded format this time round. There's over 104 matches. Versus just 60-odd previously.
That's right.
Greater number of teams as well. So with more matches, more games to be watched, you'd expect more people to be diverted away from Macau during this time. And secondly, I think is a key point is the thing is it was held in North America, and that really is the world leader in terms of sports media, entertainment, hospitality. They have great transportation as well as infrastructure. So the visitation numbers were record-breaking this time round, both in terms of physical people visiting the stadiums as well as TV viewership. So the combination of that, it's not surprise really that the impact for Macau GGR this time was greater than expected. Also, you've got to take into account weather hasn't been very cooperative throughout this month. You've had a lot of typhoons, you've had red rainstorms, black rainstorms. So I think those combination of factors probably led to the miss in terms of July.
Sounds like you're seeing this month of July as a bit of a blip. What are the prospects for gaming recovery for Macau?
Yeah. Well, historically, when we look at the impact of the World Cup and the Euro Cup, there has always been a recovery in August, and it's been between 5 to 6% snapback. This time round, we think because the impact from the World Cup was greater than expected, we would expect probably potentially a bigger snapback in terms of the August recovery. We've also seen the casino operators are lining up a very strong set of entertainment and shows and concerts from August onwards. And I think thirdly, the point is we also noted that even MGM China, during their second quarter results announcement last week, they even alluded to the fact that post the World Cup, they're seeing market volumes pick up quite nicely.
Okay. Yeah. Well, and also there was obviously the joke was there was the World Cup and there was also the casino that was Korea, which is obviously moving some of the attention away. That's not according, by the way, to Peter's analysis. That's just me speculating in my head. Peter, fantastic. Thank you so much, Peter Tang there. Asia Consumer and Leisure Analyst at Bloomberg Intelligence. And by the way, just on that point we were just making there, right? We have a fantastic piece out on the Korean markets and the retail story that really has, I guess, in many ways ended quite discouragingly for many people who took out leverage.
Is it turning out into a political issue, right, for Lee Chae-myung after they kind of let the leverage ETF genie out of the bottle?
Right.
They can't put it back in now. And it's turning into a social issue. People are angry, right, to your point, about how it's a bit of a gamble, I guess, when it goes to South Korea.
And it was too late for them to come in to help salvage the retail investor, which is, I think, interesting conversation because that was a very short span of time between when those products were let loose into the market, how quickly the market reacted to it, and then how quickly it's turned around. Anyway, that's another kind of items that we'll get into at some other time. But I think one of the other things we just touched on there was just the weather, and I think one has to simply be in Hong Kong to just understand how it's been absolutely terrible. July was the rainiest, the wettest July in almost 3 decades. Mary Hui is with us here to just help us understand and put into context, Mary, how rainy it's actually been here in Hong Kong.
Yeah, you're right. You're not imagining it, but it's absolutely been a very, very wet, exceptionally wet July. It was several weeks of incessant rain, and at one point I thought, okay, I should probably check the data to see how this compares with the average. And as of the 30th of July, we don't have the latest data yet for the last day of the month. We're nearly at double the climatological average for what we would typically see in rainfall for July. And that's a lot. And I guess people who are dependent on sunny skies, clear weather for business are probably suffering a little bit.
So what's causing all this? Is this climate change?
It's hard to say right now. There hasn't been a direct kind of attribution study, but the broad background effects of warming temperature will drive up atmospheric moisture in the air, and that will typically dump more rain over Hong Kong and other places. Right now, I guess we can broadly say that these very active low-pressure systems around Hong Kong over the past several weeks have just dumped a lot of rain continuously over the city, and it looks like we're going to see a little bit more. And Hong Kong will just see, we're likely to see more extreme rain episodes going forward.
Yeah, so brace for that, right? Well, I'm visiting this week, I suppose. Mary, great to have you. Thank you so much, our Bloomberg weather reporter, Mary Hui, for us. And you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter out every Thursday. You can sign up via scanning the QR code on your screen or via bloomberg.com/newsletters. This is Bloomberg.
Unless US has a lot of hyperinflation, and then if the Fed were to price another so a big Fed hiking cycle, 4 to 5 hikes in the market, I think we have probably seen the top in dollar yen, right, at 164-ish, and now the next level to watch is actually not on a weaker yen but a strengthening, right. I think 155 is the level that market is watching.
Masahiko Liu, Senior Fixed Income Strategist at State Street Investment Management. Of course, Dave, we've been watching as well what the investor community is saying about the potential for earlier rate hikes from the BOJ. Given these bouts of intervention or suspected intervention, the Daiwa CFO talking about how a rate hike could come earlier based on the data that we're getting. So certainly something that even, I guess, the top banks in Japan are watching out for.
Yeah, that's the missing piece. That's the missing major piece of this, right? You can intervene all you want, but if the rate story doesn't sort of jive with that, then that's just lost billions and trillions. But it looks like markets are pricing in more hikes, earlier hikes coming out of the BOJ. And of course, there we go, some commentary coming through. And expect to hear a lot more commentary coming through out of earnings season this week, and really how Japanese corporates feel about the exchange rate and the recent moves that we've seen there. Okay, so we're off lows of the day on dollar yen. Right, very quickly, we're looking at Alibaba, and of course, the big news in the last hour is this new release, Anthropic tier performance, 2.4 trillion parameter. Is the latest one there from Alibaba. It's just really the latest in a series of releases over the last few days or so coming out of the AI complex in China. Goes into the STAR 50, which is mirroring the sell-off we're seeing elsewhere in the region.
Yeah, I mean, the rethink about how much memory, how much compute do you actually need on what was a reassessment of a very, very crowded trade that turned sour. We're seeing how those trades are coming under pressure today, and, China not an exception. You're seeing those chip stocks sinking almost 7% on the likes of Huatai on a day where investors are also, I suppose, grappling with what we're seeing in chips. That's it for the China Show. Insight with Haslinda Amin is next. Stay with us.